As a major corporation, what do you do when you suddenly recover lots and lots of money? Do you spend it into the economy? Do you drop dollars from a helicopter on the people below? Or do you simply buy back your own stock? Take a guess. You came here for the truth, so let me unveil that for you. Today we're going to talk about stock buybacks. We're going to talk about what corporations are doing. Let's begin looking at the announced buybacks year-to-date period, and you will see that in 2018, looking at a record level, and it doesn't surprise me when you see what has happened with this recent tax plan. All of this money is going to be repatriated. Now, there's an opportunity here to put that back into the economy somehow, build up businesses, buying different facilities, getting things going. But what a lot of these corporations are going to do is simply buy back their own stock. This is done in times of uncertainty, generally, historically. Now, you can see though, over the years, it's been an obvious trend. They've been buying back shares, different every year, of course, but this is what happens. They're not really sure, they're being cautious, they're buying back their own shares. There have been a few primary reasons why equity prices have continued to rise. Number one, central bank intervention. That means printing money, buying shares. I've talked about that in nearly every video. But we've also had the buybacks, and the buybacks help to push up the stock prices dramatically. And this is something that goes on for, in times of desperation, and you will see that today. It's happening, here. Look at, we're only mid-February, and already we are seeing these levels of buybacks taking place on an annualized basis. We can only imagine how serious it's going to be. US and non-US share buybacks, much of the similar information, just another chart that basically splits it up where you can see it for yourself. But essentially, look at the year to date, already looking at to make records. We will definitely see these records. It looks like this year that corporations are seeing a lot of money that's going to be flowing in if they decide to bring it back on shore, and that will end up pushing share prices higher. Shareholders, obviously, they're going to be very happy, but it's not going to make its way back into the economy, at least somewhat. I mean, I'm sure some of it will, but not directly. They're not going to take those tax dollars and then give it to the government necessarily. They're going to be finding a way, buy back the shares, push the prices up higher, and continue to get more investment. That's the way that these companies do it. They can indefinitely defer paying the taxes, and there's always a way around it. I don't know the method that each company is going to use. I don't know the amounts and totals and everything, but ultimately, if they don't have to, they're not going to pay tax. It's just the way it is. All right. Buybacks are mainly funded by debt. Net buybacks and change in debt from US companies report and account. You can see the blue line, net buybacks, and the red line is a change in debt. Definitely correlated. I just wanted to show you that very briefly. No matter how far we go back, there is a correlation that is clearly evident, right? Debt is a very, very powerful tool that is used by central bankers. They decide at any moment what the banks, who's loaning, everything. They are the ones that are adjusting this at any given time. All the central banks get together, the commercial banks get together. They decide what will be there at any given moment. They're making that decision. They're going to decide whether they should pull back on liquidity, dry it up, or will they give it out? So we're simply waiting on their every decision. It's very important. So, looking at this example here, Cisco has become the first tech company to pass the rewards of the US tax reform directly to its investors with the announcement of a $25 billion stock buyback plan that contributed to a 6% bounce in its share price late on Wednesday. And that is very clear, it's evident. Here's the example that I just talked about. looks immediately. They found a way, they bring the money back, they buy back their stock to the tune of $25 billion worth, and immediately their stock bounces 6%. So that's something that we can see definite, concrete evidence of what I'm talking about. Cisco had $71 billion of cash held offshore at the end of January, amounting to the third largest pile of unrepatriated foreign earnings of any US company after Apple and Microsoft. So they said, hey, let's try and, find a way to make this happen. Well, they have done this here, and basically this paragraph is just talking about Apple and what they want to do. They haven't done so yet, but we'll see how that works out. One of the continued trends that's not a good trend, it's the retail stores closing. You may have seen these in your area where you live, and I know that everybody's heard of them taking place in their city. You might see it in the news. There are not just 1 or 2 or 3 or 5 different stores that are closing, and it's not all within one particular theme. I'm noticing retail stores in general are not doing well. Let's say how they were doing 10 years ago compared to today, there's a significant change. I've always mentioned this, but definitely we can see more is going online. But I would often, I would suggest that particularly in clothing stores, a lot of people, not everybody definitely, but a lot of people are still feeling that they want to go to the store, they want to touch the material, they want to be there present at the location. So I could see some stores that's, let's say, little gizmos and gadgets and things that you could simply buy from a Chinese manufacturer, get them through, let's say, your typical big box stores. They don't need to necessarily have a storefront, or they need less storefronts, less retail brick and mortar type locations. Some businesses I could see that they're going online. That's where the business is going. They have to get with the times, or they'll simply get pushed out of it. Some businesses, I think there's something else going on here. There's definitely change that's present, and that is more and more going online, definitely. But my opinion, the economy is showing its true self here at this time. So maybe, let's say there was 2,000 store closings. Were all 2,000 because people are now buying their stuff online? E-commerce makes up approximately 9% of the sales in the US. 9%. There are different ways to look at the statistics and so on and so forth. It doesn't matter. It's still not the major contributor to the total sales. So it's interesting to know. Okay, before I rant on anymore, I'm going to quickly scroll through this list just to give you an idea of the stores that are closing and the amount of stores. JCPenney, 8 stores. Bon-Ton, 42 stores. Here's the whole list if you live near any of these places. You can check out this link, by the way. It's clark.com. If you type in clark.com, major retailers closing 2018, you'll get this list. But of course, it'll be in the description of this video. Toys R Us, up to 182 stores. Sam's Club, 63 stores. Macy's, Sears, and Kmart, you've heard about that. Pensions, their pensions are going to be fried. J. Crew, 50 stores. Gap, Banana Republic, 200 store locations. Okay, and these are very big stores. Teavana, owned by Starbucks. They closed, I think, all of them as far as I know. Every single one, yes. 379 stores. Another company, 268 stores, 100 stores here, and so on. So we are seeing, that's Michael Kors, a company that expanded dramatically. They thought that maybe they can sustain that. It didn't happen. And as a result, had to close a lot of stores here. A lot of people are going to lose their jobs, and yes, it's retail. It's not necessarily glamorous or high paying or anything else, but these people are left without work. Now they need to go reapply somewhere else, but hey, other retail stores are closing as well. So a lot of people need to find some other business that they're going to get into. They need to find something else to help them out. The economy, as far as I'm concerned, is not doing well. This is a good example of that. Buy Low LLC, the supermarket company that owns the Winn-Dixie chain, preparing for a potential bankruptcy filing as soon as next month. They're going to close about 200 stores here. This is the real economy, and it shows itself here. It's not because, Amazon bought Whole Foods, as they mentioned at the bottom of the article here, and therefore, these companies are suffering now. No, it's not that. This is, that's not a concern for a few years. This threat that Amazon is going to be taking over and dominating the industry. That's not why we are seeing here, just in general, some big changes happening. The economy is suffering, and a lot of people are going to be unemployed. That's just the way it is. Now, there's a lot that we need to pay attention to in the next, let's say months, that are going to show its true face. A lot of people are unfortunately going to be worse off. Whatever the equity prices are doesn't really make a difference to the actual real economy, to Main Street. I'm not talking about Wall Street. I'm talking about Main Street. That's all for this video. If you found it informative, please give me a thumbs up. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, there's links in the description below. It's going to allow you to flip through the pages of these books to see if you like them. Take care.